First of all, I guess, why are you here? And my hypothesis is that the reason you're here is that your ambition is, your current ambition's bigger than your balance sheet. And you're looking for a better way to get access to financial resources to help you take your big idea and make it a reality. And then lastly, you're here because I guess you watched my Facebook video ad, and you're wondering, how it is that I might be able to help you in terms of speeding up the process of getting access to the financial resources that you're looking for. So the agenda tonight, as we advertised it, is really first and foremost, why some startups successfully close venture deals that help them fuel growth and innovation, and why some don't. And secondly, as part of that, we're going to address the concept of investor readiness. And third, we're going to talk about, are there any sort of secret ingredients or secret sauce to help you not only get investors to listen to you and take the meeting, but more importantly, go beyond and actually open their wallet to help you do what you want to do by essentially partnering with them with their risk capital to build something that you might not otherwise be able to build without that partnership. So who am I? I'm Brad Ferber. I am the founder of Very Advisors, and I've had a lot of different roles in my career, but fundamentally I think of myself as a seed investor, an advisor to companies, mostly tech startups. I'm an entrepreneur myself, been involved with a lot of entrepreneurial ventures, and I'm a lawyer. So I'm a corporate finance, securities, and M&A lawyer. And I guess before we get into the content, maybe why what I've learned over the years might be relevant and why you might want to listen to me is I have been involved in a lot of deals in a lot of places. And so more than 150 angel and VC-backed deals. And that includes structuring them, negotiating on both sides of the table, but also investing. I've been a very active angel investor, and I've also invested in quite a few venture capital funds. Now, when you're doing this kind of early stage investing, obviously the goal is that you would harvest some of these investments, and that's where the M&A activity comes in. And so my experience encompasses both as a lawyer on both sides, buy and sell side, but also some of my investments, knock on wood, they've paid out. And so I've been involved in structuring them as an investor in companies. And that also includes initial public offerings and that sort of thing. Now, in terms of the aggregate amount, people ask me, well, what's the total amount of financing? Some of these are small deals, less than $1 million. Some of them are large deals. But just on the private side, excluding the public, more than $1 billion have been raised in the transactions that I've been involved with. As an investor, I've invested in a lot of deals. As I mentioned, some of those have gone full cycle. I did have a role at a university, 2014 to 2017, basically designing and building an innovation center at a very big university, University of New South Wales, which likes to sort of think of itself as the MIT of Australia. So a lot of science and technology. And that was fun. It got me back, working with young people and the education space. Also, I've been an educator in the industry. So starting off, organizing a lot of events, teaching lawyers how to structure venture capital. That led to some other programs called Term Sheet Battle when I moved to Europe, really educating the whole community. So founders, funders, and the startup ecosystem, and a lot of different countries. And that actually was really fun for me because it introduced me to the different cultures and ways of thinking and negotiating that exist outside of the United States. Because I'm not one of these American guys who thinks you can just fly in and do everything the American way. I know that every city and every country has its own culture. I have been a keynote speaker at a university, and as I mentioned, although most of my career was spent on the West Coast in the US, for the last 10 years I've been living overseas, so Denmark, Australia, and currently I'm a resident of Switzerland. All right, so we're going to get into the meat and potatoes of the program. why some startups successfully close venture finance to fuel growth and innovation and others don't. And before we get into it, this slide I think is worth thinking about, particularly the images, because if you're on the call tonight, you're probably feeling like one of these three, and I'm going to guess it would be one of the two on the left. If you think about venture finance and you've never done it before, it may be a little bit like looking over a cliff. It's exciting, but it's a little scary. For some of you, maybe you've already taken the leap. You're in flight, you're out there, and hopefully you'll end up like this guy on the right who made it to the other side and is celebrating. So the principles I want to share with you is to help you go from that feeling on the left to improve the probability that you'll feel like the guy on the right. And I also want to just emphasize that venture finance is not just venture capital. Venture capital is one form of venture finance, but actually startups can get financing from any number of places. And statistically, I think it's important to remember that in the United States, if you just look at the US, because that is the largest pool of venture capital, only about 1/3 or 0.3 of 1% of all companies in the United States actually get venture financing, right? So VC financing, very small slice of the venture finance pie. Other ways that startups, companies, whether you're a tech startup or a traditional, they get that funding from other sources. So friends, family, or friends, family, and fools. There's crowdfunding, of course. There's different ways you can do that. Sometimes business incubators have some micro-seed, or business accelerators are real popular in the last 10 or 15 years. Of course, angel investors, and those come in different shapes and sizes. You've got the basic angel investors that have been around forever, and then you've got sort of these super angels that have emerged in the last 5 or 10 years. Most communities that have any kind of a financial or tech system do have at least a micro VC. So these are smaller venture funds that are very regional. The traditional VCs, which operate at a bigger scale. You got corporate VC, that's been really active in the last 5 or 10 years. A lot of companies, they are worried they can't innovate. They don't want to be disrupted by startups, and so they have these groups. And sometimes it's a fund, sometimes it's an innovation sort of group. There's different, non-equity, venture debt, venture leasing. If you've been following the whole ICO, STO craze, the blockchain thing, that's been really interesting. And then lastly, governments have a stake, obviously, in attracting and retaining jobs. And so there's lots of access to services and grants from local government. So I guess before I get into this, I want to say venture finance, it's all encompassing. It's not just venture capital. All right, the next slide is really about visualization. And some of you may be familiar with how athletes in particular use visualization to imagine that they, get the gold medal or whatever. I think visualization, in my experience, works, for anyone. And what I'd like you to think about is, what would it feel like for you if you achieved, all of your venture finance dreams, if you actually were successful at getting the money. And I don't know how much you might need, and I've done a lot of research. Sometimes people, they only need 100,000, or some people may need 10 million. Who knows? Maybe you only need 10,000. But the goal is that you have this thing that you want to do, and you want to get access to financing. Because you really, the feeling would be that instead of worrying all the time about whether you're going to meet payroll next week, you actually have the luxury of innovating or growing or penetrating new markets. So that gets me to my next slide, which is a tale of two startups. And I've been involved with hundreds of startups, all over the world. But I wanted to share with you my experience before we get into it about a couple that I've been involved with, because they're very different. And they're different because on the left, we've got a startup that hasn't taken off. Let's just put it that way. And I'm not going to mention names, but there's an entrepreneur I met, about 18 months ago. He came and he visited, and we had a nice lunch in Switzerland. And at the end, he said, "Well, so what do you think? Do you want to invest?" And I was like, "Well, what are you offering? I mean, what you got a term sheet?" Or he said, "No." He goes, "I don't have anything." He goes, "I haven't organized it yet, but I was just interested if you want to invest." And I was like, "Well, it's pretty early stage. Why don't you come back to me when you've got, an offer?" And he said, "Okay, fine." And, we said goodbye. And he didn't get back to me, to be honest. And I do meet with a lot of different entrepreneurs, so that didn't really concern me. But I ran into this guy about 6 months later. And he was at a party, and he came up and he said, "Well, hey, things are going really well. Do you want to, are you interested?" And again, I said, "Well, that's, have you addressed the issues? Do you have an offer?" He said, "No, not yet." And this guy, he was incorporated in the Seychelles. Long and the short was he wasn't investor ready, obviously. And then it was about 6 months later, I was in a kind of an angel network, and this guy had actually paid money to stand up on stage. And the reason I'm sharing this with you is that sometimes entrepreneurs, they're pretty desperate to try and get access to capital. And in his case, he actually paid, literally like $3,000 to get up on stage. And so I went up to him afterwards and I said, "That's great. I'm glad that you finally got, this going." And it turned out he'd spent all of his money, available capital to go up on stage, but he still hadn't done any of the homework. He still didn't really have an offer. And it was sad. Now I contrast that, and I want to share this other startup with somebody who was a bootstrapped, just actually a fairly modest entrepreneur who left his job at Boeing. This is in Seattle, age, 45, 46 at the time. And he had this idea that if he built a directory of all the high schools in North America, that people could figure out how to find their high school classmates. So back in the days before Facebook, this was a big challenge, maybe 20, 25 years ago. So he built this out. He borrowed money from friends and neighbors. It was pretty messy. But ultimately he said, "Look, I built this infrastructure, but in order for me to populate the directory, I need to engage in online advertising, and I need a bunch of money." And so, I helped him structure a deal, and we found some investors, about $1.5 million, to engage in what was essentially a strategy to acquire customers. And it turns out that the ability to acquire customers at the cost, the budget, we could do it more effectively at cheaper prices. And secondly, it was a freemium model where you could upgrade him to a paid member. Now, based on that, he was also able to raise a venture, real venture round, about 12 million, 6 months later. Now, why do I talk about this? This company, which became known as Classmates Online, maybe some of you guys have heard of it, it was just a wild success, even after the dot-com collapse, because it had this model. The reason I mention Classmates is it's an example of a company that could never achieve what it achieved without outside capital. It had to have outside capital, because if all they had was this little directory with nobody going to it, they were never going to generate the cash flow to capture the big market. So it may well be, I guess, going back to that first slide, when you think about venture finance, you've got to really think about what is it that you need, why do you need it, and who do you want to get it from? So this leads to the dirty little secret of successful startups. And what I'm going to share with you is, in my view, the best method to get investors to not only take your meeting, but to actually open up their wallets and give you the money. And that is, first and foremost, you need mindset. And what do I mean by that? Yoda, famed Yoda, not Baby Yoda, this is the original Yoda. Yoda advised Luke that he must try not. He must do or do not. There is no try. And what he's really saying is you need to have a state of mind like a champion. You need to eliminate the possibility of failure and visualize success. Now, if you do that, you won't necessarily be successful, but if you don't do that, it has been my experience, particularly when it comes to venture finance, you just won't get it done. You have to, first and foremost, have the mindset. Secondly, you have to make a commitment. And the commitment is pretty substantial because venture finance is complex and it takes time. And in my experience, people ask me, how long does it really take? In my experience, it'll take 3 to 6 months minimum. And it'll take the CEO's time and mind share and attention about 50%. It might take more. People find that this is really hard. And so the commitment level is key. So mindset and commitment. Now, part of the commitment is that you're going to educate yourself. You need to make sure that you understand the rules of engagement before you get out there on the battlefield. And that means you need to have this, what I guess I'd call foundational knowledge about, depending on what you're trying to do, things like, am I in fact incorporated in the right jurisdiction? Am I structured in the right entity? If I want to bring in investors, what are the instruments? Is it an equity? Is it a convertible security? Is it non-equity? Whatever it is, you need to basically educate yourself in order to be successful. You're not going to win, obviously, if you don't even understand the rules of the game. So we're going to go to the next slide. And this gets to, what does it really mean to be investor ready? People talk about that. Oh yeah, are you investor ready? There's, all sorts of folks. What I talk about investor readiness, I sort of think of this slide with the train conductor. Why? I don't know, because I live in Switzerland. Trains always run on time. And when you go to the Swiss train conductor, actually now you buy the pass on your mobile phone, but the conductor always does come and check. And the thing is, when there's that transaction, which is I'm going to get on the train, they're issuing me the ticket. Now, what that presupposes, of course, is they've already engineered the train, they built the train, they provisioned the train's fully staffed, and the train tracks have already been laid. And in the investor ready thing, I guess what I'm saying is, if you really are investor ready, then you're a little bit like the train conductor. You can do that transaction quickly. Now, one of the things that, in my experience, prevents people from investing is if the company doesn't have his house in order. It's kind of like I was saying with the first guy. And entrepreneurship's messy. Sometimes, you got to do what you got to do. But, nobody wants to invest in a venture that's disorganized, right? So it's okay if you like to live in a messy house, if it's your house and nobody else is an investor. But if you bring in third parties, they're not going to like it. They want to know that you've got your house in order. So that's one of the things that is really boring, but it's really important. And if you don't do it, I'm telling you that your chances of success are pretty low. This one, strategic identification, it kind of gets back to how do you find these potential investors. I'm from the West Coast, United States, and Washington State. The apex predator is the orca whale. I love these creatures, the orca whale, right? And so if you think about the ocean of investors that are out there, there's lots of different species, right? You've got the killer whales, you've got the salmon, you've got if you look at this slide, you've got krill, the zooplankton, you've got crabs and lobsters, and I don't need to go on. But it's not that different, frankly, than any other ecosystem and the investor ecosystem. So it may be that your venture, you don't need to go whale hunting, right? I mean, everybody reads TechCrunch is like, oh, I got to get the whale, SoftBank or whoever it is. No, actually, if you look at the total aggregate amount of financing from all those sources that I talked about at the beginning, you aggregate that, and it may be that your ideal investor actually lives right down the street. You don't know. And so what you need to do is figure out, okay, how am I going to find the right investor, and how can I offer that investor something so that it's a win-win, okay? So this gets back, it's important to understand how this ecosystem works. Now, getting back to, create the compelling offer, obviously, if you're going hunting for orca whales eat seals and they eat salmon. So actually, some orca whales only eat salmon, and some orca whales only eat seals. So, but as you go down the food chain, whatever it is that whoever it is you're targeting, you need to create compelling offers that are going to appeal to the investors. And that means, some investors may say, I only invest in companies that are located within 45 minutes. Here in Europe, where I live, I find, a lot of angel investors will be limiting themselves solely to, say, for example, the country where they live. And frankly, in Switzerland, where I live, they speak French in one part and German in another and Italian in another. And I've met investors who say, I only invest in German Swiss companies. Okay? So you just got to make sure that if you're out there looking for investors, that you create compelling offers for the folks that you're targeting. Now, this gets back to my next slide, which is fish where the fish are. And I grew up in Seattle, Washington, Puget Sound, and I used to go fishing all the time, and I sometimes would come home, pretty much always with fish about this size. As an adult, what I have decided is I like to catch bigger fish. And so I go up to Alaska fishing. Now, why is this relevant to you? My hypothesis is that if you want to catch fish, then you're going to have to go where the fish are, at least the fish that you want. So if it turns out, and I'm going to guess some of the people on this call, this is based on a lot of research I've done over the last few years for people who have contacted me. Some of you may be living in places where there is not maybe deep pools of capital. Maybe you don't. If you're in Europe, obviously there's the big pools, London, Berlin, Amsterdam, Stockholm, Paris. But let's say you live in some of these other places. They're nice places to live, but maybe they don't have deep pools of capital. So are you limited by your local place? Let's say you want to catch salmon and you live in the interior of Canada. You're not going to catch salmon. You are going to have to go. You're going to have to figure out how to get where the investors that you want, where they live, and how you can make yourself attractive. That's, is it a dirty little secret? No, this is common sense. But so many people that I talk to, I'll give you another story. I met this guy who has a great sort of a cybersecurity company in Poland, and he's been looking for capital for like 2 years, and he's got a good company. And I said, well, what's the problem? He says, nobody wants to invest. And I said, well, where have you looked? He says, I've talked to all the guys in Warsaw. And I said, how many? And he said, 5. I guess there's 5 VC firms or something. And they didn't say yes. That's just that's not going to get it done. If you're a cybersecurity company, you're probably doing business globally. You go to where people invest in cybersecurity companies. And there's lots of places that will do it if you've got the right company, if you got the right team. All right, getting back to secret sauce. What is it that gets investors to not only, excuse me, take the meeting, but open their wallets? And this is really, it's not rocket science. I've spent 25 years looking at why some startups are so successful at raising money and why some don't. And ultimately, it has to do with this slide. The ones that get access to the money are the ones that figure out how to tell a story and create demand for what they're doing in a way that creates a little bit of a stampede. And that's when greed, and when I say greed, I'm talking about the greed of the investors, overtakes the fear. And so let's talk about what's the fear. The fear is, if you're an investor, that you're going to lose your money. You might lose all your money. In fact, it's a legitimate fear if it's a tech startup, because one of the statistics about venture-backed tech startups is that more than half of them go to zero. So, it's a good chance when you make an investment that it could go to zero. But at no time when you make that investment do you think, oh, it's going to go to zero. No, you're placing a bet that it's going to get you a 10x, right? And so that's part of this portfolio strategy. But bottom line is, when greed overtakes fear, what the investor's afraid of is that they're going to miss out. They don't want to miss out, right? And so not every deal is like that. Some deals, it's more like trying to convince a bank to give you money. Why does the bank give you money? They give you money because they're going to try and get a return. It might not be a 10x. They're going to get their money back and take a security interest and so on and so forth. But ultimately, in a competitive marketplace, if you've got a great story, then the capital's there. There's never been more capital ever in the history of the world. And so it is out there. I mean, there's just money everywhere. But that money obviously is only going to be allocated, and should only be allocated, to the best and the brightest, right? Theoretically, the money should go to the best teams with the best ideas. That's what you hope for. Now, in terms of how do you create a sense of urgency, well, this gets back a little bit to my train conductor. And once you've got a group of people that want to give you their money, you need to create this process that's super simple, as easy as 1, 2, 3. And I've got these little diagrams. If your closing process is complex and it requires people to invest a lot of time and energy just to figure out how to give you the money, even if at one point they are interested, they'll probably lose interest and you won't get it done. So the whole point of this is you want to try and structure your offering so that it all comes together, and you can, when the time is right, take the money, like be the train conductor. They give you the money, you give them the ticket, they get on the train, you're moving down the track, and hopefully you've got that feeling that we described earlier, which is you now have the resource to do what you want to do to achieve the big dream. That gets to the next thing, which is, you're on the call and you're thinking, all right, what can I do today that would increase the odds that I'll be able to get my company the funding? And what I'm here to do is to share with you that, we have invested with a lot of research, not that dissimilar to what I was talking about with what you got to do. We've invested a lot of research into figuring out how we can create products that will help you get where you want to go, but you do so faster and with more confidence. So that's what I want to share with you today. And you don't just have to take my word for it, because there's lots of others that have that worked with me over the years. And James is a good example of somebody. It's a good story. It's a good European story in this sense. James was just graduating from, he's a Latvian. He and his co-founder are Latvian. They flew to San Francisco and they participated in the 500 Startups Accelerator. It's a great accelerator. And at the end of that, they were graduating. And I'd known one of them for a few years from other deals. And so they needed, not even that much capital. I'm not going to say how much, but it really wasn't very much. And they weren't finding it. For whatever reason, they weren't finding it in San Francisco. And so I said, okay, if we can get at least a couple more angels in Europe, closer to your home, I'll participate. And they did that. And sure enough, they took the money, they exceeded our expectations. 6 months later, they needed a little more. We gave them a bit more. And lo and behold, this little company, it's called Printify, just starts taking off. And the great thing about it is they were living the dream. They were taking sort of this Silicon Valley model. They were incorporated in the United States and they sold securities based on a Silicon Valley model. But they were building the company and are building the company in Latvia, Riga. And it's been a phenomenal success. And after building that and getting significant revenue growth, they were able to go back to the Valley. And the second time around, they were able to raise about a $3 or $4 million seed round with some very sophisticated investors. So they've been through this program that I'm talking about. Somebody else that I've worked with that's turned out to be, well, he's a brilliant guy. And I knew that when I met him the first time. Alex is a general partner at Andreessen Horowitz. And when I first met him, I was CEO of a tech company and was at some conference, where, shareware, software nerds go. And he was this young guy, 23, 24, and he had an idea. He hadn't even incorporated yet. But his idea was like, God, that's a good idea. And so at the, cocktail party, I said, look, I'll be your first customer. I'll take the risk. And so we developed a relationship and we signed a contract and we were his first customer. And on the strength of that, though, he's very strategic. He was able to basically use that prototype and raise a lot of money from very high quality VC funds and build his company. And I continued to advise and mentor him as he built the company, a little bit like James has done. And ultimately they sold to Visa. It's a great story. I learned a lot from Alex, and I think in the early days he learned a lot from me. And so anyway, here's another guy that Sam, kind of interesting. So I've been doing this research, and actually Sam, he was helping produce some of the videos where I was talking about, some of the videos that helped you, I guess, connect with me. And he was at the time wanting to just bootstrap his company. He didn't want any outside investors, like a lot of people. This was his baby. But as I described, the stress associated with, okay, what if you want to innovate? How are you going to do it? Are you going to just rely on your existing resources? Slowly but surely, he started to think, geez, maybe I need investors. And in the end, when he went out there, he didn't know how to do it. And so actually, one of the things I'm going to talk about is what we call the venture finance audit. He said, Brad, your courses are great. Frankly, he knows what we're doing. He said, but I really want somebody to help me because I think I've got somebody who wants to invest. Of course, it was a non-equity deal. It was going to be a revenue-backed note. And I was like, okay, well, let's see what we can do. And so on the strength of that, I started working with Sam, and I am working with him. And he's created his company. He's followed the advice. He was based in Eastern Europe, Poland, Ukraine. And he realized that he wasn't going to get access to the financing. Fish where the fish are. He went to the US, he went to London. He's been successful fishing where the fish are. And already he's well on his way to closing his round of capital. So these concepts work. And I enjoy working with the companies. For the last 30 years, I've been involved in the wide world of venture finance. As a practicing corporate and securities lawyer, I've been involved in negotiating and structuring more than 50 mergers and acquisitions, both public and private, and more than 10 public offerings. Helping visionary entrepreneurs and promising young companies get access to the capital they need to fund their dream, something that can change an industry or in some cases even change the world. That's the kind of thing that I like to be involved with. That's my passion, and frankly, that's my life's work. If you're a visionary entrepreneur of a promising startup, but your ambition is bigger than your current resources, well, that is usually where I can add the most value. That's my sweet spot, and that's where I can help you. But I don't want to kid you. The road is not easy, it's difficult, and you need to make sure that you know what you're doing. Most companies never manage to achieve outside financing, and there's a very good reason for it. Frankly, it's just too damn hard. Ask any successful startup founder, what is the hardest thing that they've ever had to do? I think what you'll hear over and over again is it's raising money to keep the dream alive, to get to the point where they are now. So although it's hard, it's not impossible. Even if you've never raised outside capital before and you're not sure if you'll be able to do it, I'm here to tell you it can be done. You just need to learn what the methodology is, have a plan, and follow through. If you have a really great idea and you have the right mindset, you can do it. You'll be able to get access to the resources to take this idea and make it a reality. In order to do this, you're going to need to do three things. The first one is simple. You just need to take stock of where you are now. What is your current state? Secondly, you need to assess what you need in addition in order to get to a future state where you are capable of achieving the plan. And then third, you need to figure out how to fill the gaps so that you have the capability to get the job done. Trust me, there will be a gap. And once you understand what that gap is and what you need to go from where you are to where you need to go, the next question will be, who do I need to add to the team that I already have? Advisors, guides, mentors to help me address that and go to the next stage. Raising money is like climbing a mountain. When you're on the bottom looking up, it looks like a straight shot. But once you get onto the mountain, what you realize is there are some cliff faces. There might be some paths that you got to take. And that's when it's important that you have a guide to help you plan and navigate. Venture finance is the ultimate adventure sport in the world of business. It can be terrifying, exciting, exhilarating, and if you get it right, it can be extraordinarily rewarding. But if you were thinking about, say, climbing Mount Everest, especially if it was your first time, you wouldn't want to do that without a guide. In that respect, venture finance is no different than climbing a mountain. And I've designed a test. It's called the Investor Readiness Test. And it's free to you. Consider it my gift as you embark on the journey. The test is designed to assess where you are now. So whether you're already on the journey and halfway up the mountain, or you're still in the parking lot looking up, what this will help you do is to stop and take stock. What is your current state? As soon as you take the test, I'll be right here with a customized video. The video will help you understand where you are right now and what that means for the journey ahead. And you'll also have a chance to see if there might be ways for you to work with us to help you get to the next stage. So go ahead. What do you have to lose? Take the Investor Readiness Test. Watch the customized video that will tell you where you are in the journey. And once you've done that, I'll be waiting for you on the other side.